Good evening, everyone. Thank you so much for all of you all to take time out in this good rainy day in Mumbai and come out with your busy schedules on a Friday evening and attend this call. We have two sets of teams out here. We have the pleasure of having StockCal with us, and we are at JM. JM, as you're aware, is an award-winning brokerage firm in the Indian capital markets. We offer comprehensive investment management solutions to institutions, banks, corporates, individuals, high net worth clients, retail as well. We have a set of very good professional teammates with lots of experience in the financial market, which has led to our success with customer satisfaction, which has been very consistent. To enhance our experience with the clients and to take advantage of what RBI has recently done, we've tied up with a global investment platform team called StockCal. StockCal is a fintech company providing a platform making global investments very effortless, seamless, and very convenient on your fingertips as well. RBI has allowed the Indian resident to invest as much as $250,000 on a yearly basis through the LRS route, which we want investors to understand and take advantage of. This presentation, we'll have two speakers, Menika Reddy from StockCal, who has over 15 years of experience. She's been part of Kotak Securities, part of Deutsche Global Asset Management, and now she's the head of research at StockCal. She's been there for over 2 years. And myself, who spent over 2 decades at JM Morgan Stanley, a couple of years at Inam, and I'm back at JM, helping out with the PMS team. We will also have a couple of speakers who would take questions. Two of them I just want to mention very quickly. Ritu Bansal, who has over 2 decades of experience in the Indian markets and managing private clients, as well as Bhumisha, who has over a decade of experience and spent a lot of that time with us at JM itself. So very quickly, I'm going to jump on to the presentation. I hope you all can see the slides. So I hope you all can see the first slide. Something very interesting, if you see the table on the left-hand side bottom, the Nasdaq has given a 14% CAGR of returns in the last 5 years, 14. And this is despite the 21% underperformance in absolute terms in the last 6 months. This is in dollar denominated terms. Interestingly, if we were to look at India, India's growth has been a CAGR of 11% in MSCI, and this is in rupee terms. If we were to look at dollar terms, that number would have gone down to as low as 7 to 8% because of the 4% depreciation of the rupee versus the dollar CAGR over a long period of time. So clearly, the best performing asset base has been US with Nasdaq leading, followed by S&P. Interestingly, also, if you look at the performances across different markets, as shown in the table on the left-hand side top, this year has not been very easy. -5 to +5 has been the average returns YTD for most of the investors, courtesy a lot of stress in the equity markets and the global markets, which I'll take you through very quickly. Having said that, just a reminder, if you are an Indian investor where we are bullish in the medium term, the MSCI weightage is just 13% out of the 100% of the MSCI EM. So that means, in your wallet share, if you are an EM, you're putting only 13 out of 100. And a lot of money which goes out of the country may also come because of China underinvesting or China underperforming or other markets in EM underperforming. So please keep that in mind as well. So let's move to the next question, or I guess the most important question we wanted to address to us as a team. Why invest globally? I think the simplest, most important rule is diversification of a portfolio. As I was mentioning, the currency a couple of decades ago, 3 decades ago, was at 40 rupees. Today it is 80. So if you had invested in a US stock and nothing happened to it, it would have doubled as far as your rupee returns are concerned. That's only one part of it. The second is the geopolitical risk move away when you diversify a portfolio globally. And not just currency or geopolitical risk, but also the GDPs of different countries start getting taken care of for the same. So then the second question which comes to my mind is, can Indian investors invest abroad? The good news here is yes, RBI has allowed India to remit, to take out of the country up to $250,000 abroad on an annual basis for investments and expenditure. So net of your expenditure, whatever remains, you can invest globally on a yearly basis per family member over 18 years of age. The third thing is MSCI index. When we look at the overall weightage of MSCI, clearly the biggest market is US. It's 60% of the global stocks. So that's something which we as Indian investors have not been able to tap substantially in the past. I already mentioned the currency advantage, so I won't repeat it again. But most important thing for us to understand is diversification, possibility by investing abroad. The global markets are bigger than India. The currency advantage goes our way based on history, and the Indian government allows it. Very quickly, moving on to what we believe the macro situation of the world. First, pre-COVID to now, the markets globally have been all singing because during COVID times, the financial conditions were great for the markets because the US markets, the global banks in any part of the world were enabling liquidity to improve in the system. The interest rates were negative to zero, and there was growth which was declining, but post-COVID, the growth started growing pretty aggressively, and commodities was something we were never bothered about. Now, all these parameters have been challenged in the medium term. Globally, we are seeing a QT, a tightening, and the liquidity is being sapped out of US. As much as $45 billion on a monthly basis is being sapped out currently, which will go up to as much as $95 billion come September. So tightening of financial conditions are given. Interest rates too, we've seen 4 hikes in interest rates happened in US. And the US rates are currently around 2.5%. And based on any parameter we are looking at, a 4% interest rate is a real possibility. What also has happened is the GDP globally are expected to slow down. Emerging market is already seeing a slowdown trend. US also from the 6% plus growth which was happening last year is gone to literally 1/3 that number. And people are questioning that number as well. Will it be negative in a couple of quarters? Oil price has surprised everyone for the negative due to the war. Having said that, currently the oil prices, and remember we are pre-winter of US, so currently the prices of oil are in the $90 to $100 range. India has a slight edge because of the Ural tie-ups with Russia, which give them a crude oil price of as low as 20 to 25% discount at about $75 to $80. The good news for us at India is the macro situation is very resilient. Our utilization rates are now at 75%, inching up. Results of the first quarter, which have come out, seem to suggest consumption demand is back. The loan book growth has been a stupendous 15 to 20% for the private banks. They've been 13 to 15% for the system as a whole as well. China has been struggling and the China policy supports are improving now. Having said that, everyone is looking at a China plus one story, which is where India outshines. The domestic inflows in the country also have been very, very strong, which has helped the Indian economy outperform virtually any other economy as far as the stock market and the GDP is concerned of the world. And the earnings cycle too has been a lot more positive than negative. I'm just going to take a minute or two before I hand it over to Menika, our next speaker. Firstly, let's look at what tightening means. So the US balance sheet has gone to as much as $9 trillion of debt, and close to $1 trillion of debt are going to be tightened every year for the next 2 years. So which is why we are a little concerned on the economy. We already spoke about the interest rates and what the hikes have been, but there have been a lot of owner messages that if you see green outshoots of the market, and we've seen a couple of them in US, We saw the labor market data being a lot more promising. We saw inflation numbers going down from a peak of 9.1% to 8.5%, which has led to a lot of excitement in the short term to markets both domestically, which have moved up by 5-6%. India has moved up by 10% post the last increase in the interest rates by the FOMC. So a lot happening in terms of tightening of the overall policy. Having said that, don't go by markets and what's happening on how well the stock markets have been smiling of late. If you look at the table on the right hand side top, the 2-year chart in US compared to the 10-year chart in US is in a negative zone. What does that really mean? That basically means in the short term, interest rates are higher than the longer term interest rates, and the spread differential is as much as 40 basis points. That's a peak number in the last 20 years. In short, lots of economists are calling for a recession in US. Having said that, the demand in US is still not slowed down, and as you can see in the table on the bottom, if I were to look at either left hand side or right hand side, the peak inflation number is already correcting from 9.1 to about 8.4%, 5 levels, which is a good news altogether. Just a minute or two more on China. Interest rates in China are coming down, which is a plus for the world. Fiscal policy is being pushed currently. The property sector is in a very tough situation, but the Chinese government is giving a lot of free hand to locals. Even exports on China due to decarbonization, which had stopped, have started coming up. So China is looking, apart from the COVID management policy of zero tolerance, is looking a lot more better. But one point we need to think is, earlier whenever we had stress in the world on inflation, we had a big deflator coming in from China. That seems to be missing in the overall equation. Hence, a near cautious view on the overall situation. One last slide on India. Valuations. We are now trading at about 20 times 1 year forward, which very simply implies that's an average number of the last 5 years. And a lot of good news has been largely baked in the immediate term. As an economy, we would do a lot better than the rest of the world. And the premium compared to emerging market has been high 90% as against an average of 45%. So we are really moving the curve of a little bit of valuation stress coming in the country. Hence, the need of a lot more in terms of diversification. Having said that, two very interesting things we found in the market in India was the IT sector has had a lot of underperformance because of concerns of US, a lot of it underdone because of the high quality ROCs, and the auto sector, because of the pent up demand, has had a lot of love coming in from the stock market. Let me stop here and hand it over to Menika. Menika, over to you. Menka's on the slide, but she's not being able to, talk us through it. So till she does, I'm just going to use a couple of her slides till she's, into the system. So firstly, if you were to look at the interest, the US versus the INR appreciation over the last 10 years, I would say over the last 25 years, and Menka, you can note if I'm saying something wrong, but over the last 25 years, you've seen a 3 to 4% depreciation of the currency. And that very simply implies, in 2000, the currency was 40, 2007, the currency was 40. Today, in 2023, the currency versus the rupee is 80. So just purely by being in the market and the market did not do anything, one would have had an upside of as much as 50% coming in from those markets. The second point, if you look at returns on a 5-year basis, if you had invested 30,000 rupees in 3 of her stocks, which she just taken on random, but 3 very strong, high quality stocks, Tesla, Apple, Microsoft, stock gains and US appreciation of that 30,000 would have gone 10 times to as much as 2,84,579. So clearly, I mentioned the number of 14% CAGR. You add the 4% rupee appreciation. So you've seen a 20% odd CAGR happening in the last couple of years. Moving to the next slide, something which I mentioned as well. Menka's point out here is very simply put, there is a lot of stress on. Sure. Sorry, I believe my voice was not audible for the last minute or two. So very quickly, what I mentioned was the Fed is very hawkish and interest rates are expected to grow. The debate is whether they go up by 100 to 150 basis points or even more. That's a function of how the inflation of the world works. And global market performance has been fantastic as compared to emerging markets based on Menka's team's analysis. Clearly, as far as GDP is concerned, I mentioned stress in US. Her slides suggest that in the last 2 quarters, it has been negative real growth. And, things are a lot more tougher than earlier as far as US GDP is concerned. Having said that, the green offshoots, which we mentioned earlier, 2 of them. One is the labor market volume growth, which has been fantastic. And the unemployment rate, interestingly, is back to the pre-pandemic level. Having said that, the US has undergone 34 recessions since 1857 and always bounced back pretty positively after a period of time as far as the stock markets are concerned. So a lovely table made by her, taking care of recessions, and I'm just going to read the first data point. 10 years post the 1948 recession, the returns were as much as 500%. If you look back in December 2007 to December 2009, when we saw the GFC crisis, even since then, the markets have returned as much as 300% returns, but during that period, the markets were down 35. So the point she's trying to make, very simply put, is US markets have rewarded investors over a longer period of time. So where to invest? She's got a beautiful slide which you can see. YTD, the energy sector has done really very well. Obviously, courtesy gas and oil prices. But in the month of July, if you can see how the financial sector, how the IT sector, how the real estate sector, or the entire S&P 500 has done, has been very interesting as well. Some of the top performing sectors in US which she likes, which have done well, have been consumption, material, industrials, financials, and healthcare. Having said that, for us as a market to invest, there are obviously ETFs and multiple names have been showcased, and she will share the presentation with you separately as well. So a lot of positives for getting into the global market is her key final slide. Having said that, how do we as JM take advantage of that? And this is where the ideology of stacks come in. Stacks are ready-made portfolios which contain pre-packaged baskets of global stocks. You can play a theme, you can play an ETF, and try to play that entire story. Be it global diversification, you get the advantage there because the fund management team which has made it, you get expert management of the stack. And what's interesting, and a little later, Bhumi would take you through the same, is with a one-click investment, you can make an investment and the minimum holding period is not existing. And there's a lot of auto rebalancing which happens on the same as well. So without taking a lot more time, I'm going to stop this presentation from our side and hand it over to the team for questions. So the first question which comes up out here is, how do we do this entire process of taking an LRS from an investor and make it easy or menu driven? And where does JM come into the picture? Can I request Bhumi to take this answer, please?
Yes. Thank you, Vinay. Hi, good evening, everyone. So in order to, have your onboarding process, we have hosted this link on our website. The website is GM Financial Services. The path is like you can log into our website, products, investments, and US investing. In order to get onboarded, it's complete. The entire journey is completely digital. It takes around 7 to 8 minutes of your time to complete the entire journey, and your account is open within 20-25 minutes. So you have to just click on sign up and proceed ahead.
Yeah, thank you.
Yeah. Once your account is opened, your documents have been verified, you will receive an email from Stockhill stating that your account is approved. And on the same page, we have another tabular called sign in. So if you wanted to, you have to log into your account just like your Indian account, how you use Link Trade app. Click on sign in. And this is how the entire your UI looks like. Just like Indian market, we have charts in place. You can see live demo, live you can see live price of the stocks, and you can trade ahead. The entire process, right from onboarding to placing down the order, transferring funds, watching your portfolio performance, everything is digital. So this is how the stock on your watch list looks like. And as our colleague Ritu and Minka are going to talk about stacks. So we have stacks also on our platform. You can view all these stacks, and you can also see the fact sheet of the stacks. How the performance of the stacks are going across. You can click any one of the stacks which you are looking forward for, and click on the fact sheet. You will get all the details out there. And in case if you have any further doubts in terms of onboarding, in terms of experiencing the platform, you can get in touch with your respective RM, and we can answer your queries. So yeah.
So thanks a lot, Bhumi. Just one small question. With a tax perspective, things like dividend tax and all.
Right.
Is there a solution? Will we also get that on tap?
Yes, absolutely. So once you log into your account, you have a section called, my profile over here on the right hand side. On my profile, there's a section called as reports. In that, all the reports regarding to your, tax, everything you'll be getting that in one place. So your dividend statement, your profit and loss statement, capital gain statement will be available right in your login section.
Fantastic. We've got one more question which is coming. This question is actually, Ritu, I think you're best poised to take an answer out here. What are the two sectors where you can talk to us about stacks which would be differentiated? In the overall scheme, maybe the temptation is to say IT in India has not done well, auto in India has done fantastically. So, do you have stocks in those spaces, and can you throw some light of how they would work? Ritu,
Sure.
are you around?
Can you hear me?
Yes, Ritu.
Okay. Thank you, Vinay. So last 3 years have been very interesting years in the US markets, where we saw tech doing extremely well during pandemic. And compared to any other sector, it has given a return of almost 88%. So if I was to name a couple of stocks like Apple and Microsoft, average returns have been about 300% in the last 5 odd years. So tech has definitely taken a beating this year, starting when
I'm not able to unmute.
When inflation started to rise and Fed started to increase interest rates. So tech stocks did correct, and we've seen a correction of almost 17% starting this year in the US stocks itself. And the reason is because tech companies require need to borrow a lot of money for huge capex. Despite that, the last month alone in July, with elevated interest rates, elevated inflation, tech stocks have given 13% return in just the month of July. The reason simply because tech is today like consumption. It is a part of our lives. There is a lot of focus on cloud and web services, etc. So giving an example, in Amazon, the e-commerce business was down, but their web services called AWS, which is their cloud business, actually set off their losses from there and gave them a profit returns. So we definitely have a focus on the tech because that is the future. The other stack that we have a focus on is the electric vehicle portfolio. As we all know, electric vehicles have been the future. The shift towards electric vehicles have happened faster than we had expected. With the climate change moving ahead at such a fast pace, the governments in different countries have been pushing for global EV market. The global EV market itself is about, in 2020 was about $163 billion. And we expect that to be about $823 billion by 2030. The reason has been because there's been a systematic shift from the internal combustion engines, which are these petrol and diesel-driven cars. So there is a lot of upbeat demand that is coming in electric mobility. And I won't say EV, I'll talk about electric mobility itself. One example which we all know about is Tesla. Tesla has given 1100% return in the last 5 years. And this is Tesla has delivered fabulous returns despite the fact that because of lockdown there has been production closures, there's been supply chain disruptions. Despite all that, Tesla has been able to deliver all its vehicles. It's delivered about 250,000 vehicles in just 1 year, and they have an order backlog of 1 year. So these are the two main stacks that we have focused on. I would just like to take our investors through as to how we manage these portfolios to give them a little more comfort. So when we talk about electric vehicles, it is not just Tesla. It is not the manufacturer of the vehicles. There are a whole lot of companies in the entire value chain, starting from forward and backward integration. So things like battery makers, charging infrastructure. So for example, charging infrastructure is up by 34% in just a year. Then lithium suppliers, you have semiconductors, you have utilities, consumer electronics, and technologies, any which way is a big part of it. We've screened about 120 companies in this entire value chain. So one of the reasons why EV portfolio makes sense over just looking at buying one company today is because of this particular reason, that you get an exposure to the entire value chain. Now, how do we pick up stocks in this portfolio is that we have benchmarks on P ratio, PEG ratio, price to sales, price to book. Then we look at the profitability check. How is their net profit margin being? What's the kind of asset turnover that they have? The financial health of the company, the growth of the company. So we look at the sales growth, the net profit growth, the EBITDA. So these are the basis on which this algo works. So this portfolio is a complete algo-based portfolio. So the algo checks all these and then does the next level of assessment, which is the correlation. So what we mean by correlation is that we look at the stocks and see, are they moving in the same direction or opposite? Because in a portfolio, it's important to have stocks which don't only move in the same direction, because then I'm taking huge amounts of risk. So for us, there are two parameters, that's why which are very important. We look at Sharpe ratio maximization in the portfolio and risk minimization through reduced standard deviations. Another check that we have in the portfolio is that we have a maximum allocation market cap wise in the portfolio. So we go maximum to 20% in large cap stocks in this entire value chain, 12% in mid caps in per company basis, and 7% in small caps. The fund has given a 105% return in the last 3 years. These are absolute numbers. The top companies in the portfolio are not just Tesla. We have Eaton, we have Taiwan Semiconductor, we have Tag Power, we have Amrin Corp. The fund has given a return of since inception, it's been about 22.42%. In the last 1 year, it's given a minus 16%. Most of the stocks in US have taken a beating, but as we said, electric vehicle is the future, and it's a long-term good long-term bet because that's where the focus of most governments are, and the new cars that are being manufactured and that are being ordered are in the electric vehicle segment. The second stack, which is our focus, is the US tech. I did mention that though US, the technology stocks have taken a beating this year, but just in July, 13%. So technology is the future from every perspective. It's like what we call commodities and consumptions. How we go ahead and build the portfolio is that this is a large cap portfolio. So the most important thing that we do is look at what is the capitalization of the entire portfolio across internet, technology, media companies. And we then the algo divides the companies basis, whether they have a competitive advantage. And the parameters then at which we look at the companies are earnings growth, the free cash flows, the cash flow to equity, the debt to equity ratio, the price to book value, and price to sales. On these parameters, the algorithm then selects the stocks which are there and does the weight allocation on the market cap. So there are the universe is about 3,000 stocks, in which we shortlisted on this basis about 30 stocks. So depending on the 30 stocks market cap, the weight allocation is allocated in the portfolio. The fund has given about a 71% return absolute. Just take you through this. In the since inception, the fund is about 23.65. Last 1 year, as I mentioned, that tech has given a negative returns, so of 21%. But if you look at the 3-year kind of a return, it is more than double of that of S&P. Tech blue chip is the future from a long-term holding perspective and creation of wealth. The top 5 companies in our portfolio are Apple, Microsoft, Alphabet, which is Google, Amazon, and Tesla. Apart from that, we have a whole lot of other companies like Adobe. We've got Netflix, we've got PayPal, we've got Twitter also. So this fund is largely a buy and hold portfolio, but we actively look at the companies in case if we see that their market capitalization is moving out. So, for example, a year back we had Alibaba, but we exited when Alibaba fell down and the numbers of the company in the other parameters were not matching up. So these are the two stacks which we feel should be a part of your portfolio in wealth creation.
Thank you so much. A small question, small follow-up. Since Bhumi gave the comment that there's no time of holding, you can buy or get out anytime.
Right.
What is the minimum amount of a single stack, which is available, which one can buy, or is it just price domain, or is there a minimum amount?
The minimum amount is $1,000, which in Indian rupees currently is about 80,000 rupees.
So that means for $1,000. Either of the stacks, I can get exposure to 34, 35 companies in auto and multiple companies in the IT space per stack, right?
Absolutely.
Is that fair?
Absolutely. We have about 12 stacks on the JM's platform. As I said, these are the 2 focus stacks that we've spoken about. But if our valued investors would want to look at exposure in other stacks, that's also available on the platform.
Sure. Just 2 questions have come up on here, on the currency part. So I'm quickly going to take care of that, and then I'm going to try and see if Menika can hear us, because there's a question come for her as well.
Can you hear me?
Oh, you can. So great, Menika. There's a question, but I'll just address these 2 very quickly. See, as far as the dollar is concerned versus the rupee, if you go back by, the chart which Menika showed or the comment I was making, you go back to any period of time, take a 5-year period, and 4 to 5% is the depreciation of the rupee versus the dollar. Now, if US is having issues as far as their balance sheet is concerned and inflation is concerned, it's still the 3rd best performing currency, and I'm counting Russia and Brazilian currency, which have performed well. So technically, it's the best performing currency as far as serious big contenders concerned. India comes close it out there. So the other countries have a lot more issues if US has issues. So, to bet on the US currency versus most of the other currencies is a reasonable assumption to make. Having said that, Menka, sorry, we missed you because there was some problem with IT. I did make some comments on Fed and the reason for diversification and buying into the US markets, much that I'm a diehard India fan. But over to you on questions. If I missed any comment you want to make on why is it important to be in US. So over to you, dear.
Yeah, thanks, Vinay and Ritu. So, adding on to Vinay's presentation on the USD and INR appreciation. So, we are now the whole economy per se is in a slowdown kind of an economy, and then we saw how the US dollar played a safe haven kind of a currency where a lot of global investors moved to USD. And considering the Fed tightening and the situation of rising interest rates, we still believe that there is a lot of room for the USD to appreciate in the next 6 months or to 1 year. So that is why we feel that, Indian investors should look at global markets in the US per se. Adding to Vinay's comments, like US being the most matured markets today. And when we look at the LRS outflows, it has grown by remittances from India. It's grown by over 50% in the last 1 year for FY 22 at 18 billion or so UNR. USD. So that's where I think there is a lot of interest from Indian investors to remit their money, and when we look at the RBI data, it is only on the upward trajectory. And coming to sectors, the safest bets is looking at the index ETFs. This slide. The slide on the index ETFs, Bhumi. For investors who are new to the US markets, they are not sure which companies to invest in. Yeah. So they're not sure which companies, which stocks are favorable. So the safest bets would be the index ETFs to begin with. And if you look at this chart, you see the obviously YTD we are down, but look at the 3-year return. So we want to be exposed to the US markets, but we don't know where to invest. So those investors could begin with the index ETFs and then look at the sector ETFs. So why we are talking about the defensives in our presentation, Bhumi, the slide on defensives. So why we are looking at defensives as a sector? Because when we look at the past recessions or in an environment where we are uncertain about the macro trends, see, we are in a double-edged sword kind of a situation. We see inflation peaking at 9% and then Fed hiking rates, and then obviously growth and tech and other sectors being impacted. When we look at the YTD returns, I think defensives have held on, be it utilities or be it healthcare, be it industrials and materials. So that is why we are positive on defensives, and including obviously consumption. That could also be auto or any kind of consumption. So tech also is another positive for us because I think we are living with tech. Pandemic induced demand is still there for tech. Like as Ritu has mentioned in the the tech stack, why we are so positive. Like when we look at the earnings of the tech companies, a lot of their margins were impacted because of the rising interest rates. Their ad revenues were definitely impacted. So it all depends on how they would manage these rising costs, and how the USP would be like, what is that they are able to bring out to investors in this kind of an environment, and how would they manage their supply chain issues. So that is why we are positive on tech and defensives as a sector.
So, just one quick follow-up on there. When we hear Ritu, there's a little bit of contradicting views, which is very positive in my eyes. She's talking about tech. Tech has fallen, and its longevity is fantastic in terms of what they can do, to earnings growth. And at the other side, she's looking at again, in a way, tech, or I would say new age EV stack coming in. And I didn't hear you talk about the EV stack, Menka, since you used the word defensive. So any thoughts, again, on both these? You did mention tech and defensive, but any views on the auto/EV space as well?
I think, adding to Ritu's points on EV, I think EV is also somehow dependent on tech. right? We are seeing, say, Tesla, we are seeing a lot of Honda or Ford coming up with they are moving from ICE slowly and moving to EVs. So, and the market is likely to grow at a 18% CAGR. If you look at 2021 to 2030, the next 8 years, I think EV as an industry globally is likely to grow at a 18% CAGR. So that is why I think, people definitely don't want to miss out on the opportunities for EV. And Biden administration, I think the White House is emphasizing a lot on clean energy and moving on to, phasing out ICE and then moving to EVs. So there is a lot of support in terms of policies as well coming out from the White House for the sector.
We're waiting because, India and oil, when oil goes above 100 or closer to 120, a lot of pain comes on the fiscal deficit. So we're waiting for that day. So thanks for that. One quick question which we got from the investor is, really, can you explain the tax structure? I think, Bhumi, maybe you want to take that. Can you explain the tax structure for long term and short term? What happens there if these stacks are bought and sold and, we have some gains or losses? Over to you, Bhumi.
Thank you. So taxes over there is defined with a period of 24 months. Anything which is less than 24 months comes under the category of short-term investments, and anything which you hold more than 24 months comes under long-term capital gain. So long-term capital gain, there we have a flat rate which is 20% taxable, and for short term it depends on the income tax slab you are in, and accordingly the slab rate will be applied to you. So one is there on capital gain, okay. Second is on dividend. So dividend over there, the US broker will deduct 25% of your total, dividend you received. So supposing if you are eligible to, get $100 of, dividend on one stock, so probably 25% dollar will be credited to your account. And the 25% which you have already paid in US markets, you'll get a tax certificate over here, and which you can file it at a time of filing your income tax return. The capital gain you have to pay in India. You don't have to pay in US. So that's how I hope that answer your question on tax part.
Thanks a lot.
Bhumi, can I add? Can you hear me?
Yes, please, Ritu. Please go.
Okay. On the tax side of it, Bhumi, there's a slide on the tax. When it comes to tax, there are two ways the tax is divided. So if you are investing in stocks, the tax is 2 years. It's the long-term capital gains, which is 20% with indexation. But in case if you're investing in ETFs and you are investing in funds, then your taxation is long-term capital gains is after 3 years, which is 20% with indexation. There's no tax which is deducted by at the US's end on your capital gains. You bring the money back to India and you file the taxes. At the time when you're filing your taxes, you pay for these taxes here in India. But on the dividend, there's a slight difference there. On the dividend, there's a 25% TDS. They call it withholding tax out there. So there is a 25% TDS which is deducted on your dividend in US itself. And there's a form W8 Ben which is issued against it, which you can download from your account. So suppose, and the balance taxes, then you have to pay in India. So suppose you are on a 30% taxation slab, then you pay the difference of 5% in India. So these are the two main tax things. It's very simple. It's not very difficult. The third, which is a very important thing to know, is that, and it is at India's end, is whenever you're sending more than 7 lakh rupees through LRS, there is a tax collected at source, which is again adjustable in your income tax. Thank you.
Absolutely. So very important that, if you're putting $250,000 to the rest of the world, they take a little bit more, and you can keep that a little bit more, to be able to claim versus your other tax when you do your final tax calculation. We'll wait for half a minute more, if there are any other questions, because it's already 50 minutes since we've started. Anybody else wants a final comment? I want to summarize if there are no more questions. So any other final comments from you all, or else I can summarize what we've said so far. Bhumi, Ritu, Menka, any of you all? Okay. So just what we've tried to tell you guys as a team is we have concerns on the world economy, courtesy the tightening starting from US. Interest rates are up, GDP is slowing down, inflation at 8.5% in US is not normal. The 2-year, 10-year chart of US is not a great chart as far as investments are concerned. Having said that, over the last 5 years, the second point we want to make is US has been the best outperforming market, both the currency as well as US as a market, and Nasdaq shined out there. The third point is keeping these 2 points in mind. Diversification is the name of the game. You club that with the appreciation of the currency, which you get especially from US historically. It makes life much better for an Indian investor. The fourth point, LRS has been allowed by RBI. The maximum amount we can spend for an individual over 18 years of age with a PAN card is about $250,000. Remember what Ritu commented on the tax angle. And the fifth point, we have experts like StockCal, which have stacks, where they believe, they can make a lot more money based on the historic track record, which we at JM, along with them, are proud to showcase to you. And it should be easily doable by you all as investors. For any other questions, either on how to invest or what are stacks, what's happening in markets globally, please feel free to get back to your GM representative, and we'll more than happily give you answers. Thank you very much, all of you all, for spending quality time with us. We hope this presentation was useful to you. Thank you from all of us at StockCal as well as GM. Have a very good weekend. Cheers.
Nice. Thanks, Vinay and Bhumi. Thanks, Ritu.
Thank you.
Cheers, guys.